Good afternoon, ladies and gentlemen. Welcome to the FSDC Industry Exchange Series. My name is Rocky Tong, and I'm the head of research for the Financial Service Development Council. Today, we are launching a report entitled Boosting Market Liquidity and Diversity, Enhancing Hong Kong's Competitiveness as an International Capital Formation Center. And I'm very glad to have a distinguished panel with us. In the middle, it is Lisa Chong, who is a partner of Slaughter and May. She's also a member of our Policy Research Committee. Then Mr. Edward Au, Southern Region Managing Partner, Deloitte China. He's also a member of our Policy Research Committee. Then Angelina, she's the Chief Executive Officer of Straightforward Finance Limited, very important partner and friends, throughout the years, and glad to have their support for this paper. And last but not the least, we have Dr. King Au, Executive Director of FSDC, who runs the operation of us. Today, we are going to talk a little bit about how we can deal with the liquidity issue, which is a very important topic to our capital market. As we all know, IPO performance can go up and down, but liquidity stays and drives the market activities. And this is exactly why in August 2022, last year, we issued a paper, and the number is paper 54, Observations on Market Liquidity Enhancement. We are glad to learn of the setup of the task force on enhancing stock market liquidity, which is very much in line with what we wish to see in 2022. And that said, we do believe that it presents a need for us to regularly assess its listing and regulatory frameworks to ensure that they remain responsive to the evolving needs of diverse investor group. And therefore, with this paper, Lisa and Edward led the working group, and Angelina and the other friends of ours have contributed tremendously to our work. And today, I'm going to pass the floor to Lisa first, who will be sharing with us some of the high-level comments and observations of the paper. After which, Edward will also contribute his 2 cents on this paper, and then we will follow with a panel discussion where Angelina and King Au would also be joining us for the panel discussion. And for those of you who are joining us online today, please do type in your question in the Q&A box, and we will be answering them as much as practicable. And there you go. Lisa, over to you.
Thank you, Rocky. Good afternoon, everyone. We are pleased to introduce this research report. Liquidity and diversity are no doubt fundamental pillars for the sustainable development of Hong Kong as an international financial center. Hong Kong should always keep pace with financial innovations around the world and changes in global investors' appetite. In particular, investors seek emerging and private market investment opportunities with a view to diversifying their investment portfolios and improving their investment returns. And small and to mid-cap companies and pre-revenue companies also have financing needs. As a leading international financial center, Hong Kong is committed to nurturing and facilitating financial innovations and cultivating the balanced growth of a diversified financial ecosystem, covering both traditional and non-traditional assets. And of course, Hong Kong recognizes the importance of maintaining the high standards and integrity of our financial markets and protecting the interests of the investing public, in particular in the light of the retail investors' active participation in the Hong Kong market. The primary recommendation in this paper is to introduce a professional investor-only market to facilitate market innovation and the sustainable growth of emerging investment products. The introduction of a professional investor-only market is going to take some time. In the meantime, the paper also recommends a number of short to medium-term measures in order to improve liquidity and diversity in the Hong Kong markets. These measures are to explore synergies between our GEM board and other markets, to review the Hong Kong stamp duty regime in relation to stock transactions, and to develop a strategic framework to promote education about new non-traditional asset classes. So going to the next slide, I'm sure you will all agree the importance of market liquidity to the sustainable success of an international financial center. Market liquidity helps managing volatility in price and improves transparency in pricing information, which will facilitate the development of an efficient and transparent market. Maintaining ample market liquidity across a diverse range of asset classes would benefit the sustainable development of a robust financial market. The availability of innovative and alternative asset classes would broaden the investor base with different investment preferences and strategies. A broader investor participation is also expected to create correlations and independences in trading between traditional and non-traditional investment options through cross-asset analysis. All of these are expected to allow a more comprehensive understanding of the overall market and therefore better inform investment strategies, improving the efficiency of our market. One particular example of growing non-traditional asset classes is private market investments. Private market assets are reported to have historically outperformed corresponding public market indexes over the last 20 years. While the private market remains much smaller than the public market, it has in fact grown significantly in the last 10 years. You can see from the slide the relative changes or growth in the public market and the private market. The asset under management of the global private market expanded at a compound annual growth rate of more than 10%, compared with a 6% growth in the global public market in the last 10 years. The growth is also reflected in investors' demand for private market assets. In particular, family offices have shown a strong appetite for alternative investment products and emerging markets, as you can see from the slide. Going to the next slide, you will see the challenges posed by the private market in the light of its own nature. Some of the changes are summarized on the slides, in particular, the high risk arising from the potentials of an efficient price discovery process, lower level of due diligence, and lower liquidity. But of course, there are also opportunities arising from a new market in the private market world. So here are some of the examples of other exchanges tapping into the private market, whether independently or through collaborations with digital platforms. Going to the next slides, you will see the financing challenges faced by some of the small cap and mid-sized companies, as I mentioned earlier. These companies represent an important part of our economy. GEM, as you know, was established with the objective of bridging the financing gap of these businesses, though for various reasons, that objective might not have been fully achieved. As you can see from the slide, other exchanges have been working hard to address the financing needs of small to mid-cap companies, in particular by establishing separate markets, as you can see from the slide. So going to the next slide, you will see our primary recommendation is, as I said, to introduce a professional investor-only market to facilitate the innovation and sustainable growth of emerging investment products and alternative asset classes. One of the key features of this market is that in order to facilitate financial innovation, the regulation, which is of course very key to the success of a financial market, will be based on disclosures instead of prescriptive requirements as to the suitability of the products. The FSDC policy research team has conducted a survey to ascertain investor interest in a disclosure-based private professional investor-only market. The result is summarized in the slide. As you can see, 71% of the respondents expressed an interest in a disclosure-based PI-only market in Hong Kong. In particular, investors will be most interested in a broad range of investment options, market liquidity and depth, and reasonable trading cost. So let's look at some of the details of our recommendation as to a PI-only market on the next slide. The market is proposed to address the high risk posed by new investment products. The high risk level would need to doubt over the suitability of these products for the general investing public, in particular retail investors. Access to these investment products is often restricted to professional investors who are considered to be more sophisticated and can tolerate a higher risk level. The absence of an established and credible market makes it difficult to improve the liquidity of these products. And of course, the lack of liquidity would make it even more difficult to allow at some point the wider investing public access to these products and therefore hinder the development of a market in these products. So the idea of a new professional investor-only market is to create an efficient market for a broad range of emerging investment products with a view to facilitating and sustaining the development and growth of new investment products. This would put Hong Kong in a much better position, not only to follow, but also to lead market innovations. Now, we appreciate that the creation of a new PI-only market is not going to happen overnight. So the next page will summarize some of the short to medium term measures suggested in the report. Firstly, we suggest that Hong Kong should explore synergies between GEM and other markets. Now, as you know, the Hong Kong Exchange recently signed an MOU with the Beijing Stock Exchange for the long-term collaboration aimed at cross-listings. Collaboration with the mainland could provide a fundraising platform for small and mid-sized companies. Hong Kong should also look at collaboration with other markets, not only the mainland, in particular, as that will consolidate Hong Kong's position as a truly leading international capital formation center. The possibilities of expanding the scope of existing mutual market access schemes and multilateral trading facilities should be explored. Going to the next slide, I mentioned trading cost. So stamp duty is another area which we should look at. The slide summarizes the stamp duty position of key financial centers around the world. It is important to ensure that Hong Kong is aligned with other major markets. It goes without saying that transaction costs would be a relevant factor of market liquidity. And finally, we recognize the importance of education for the sustainable development of innovative investment products. Investors' education is, of course, very key. In particular, when retail investors should ultimately be given access to new investment products. Hong Kong will also need to ensure that its intermediaries and other professionals in the products and in the market are well equipped with the necessary expertise and experience in advising on and trading these new products. So I will now hand over to Edward to supplement the presentation.
Thank you, Lisa. I would like to supplement that this recommended PI-only market is not set in stone, in the sense that this will not last forever, I believe, and possibly is only the initial or beginning phase to facilitate market innovations and also to grow the emerging and other products. Because as you said, as you listened that, we also recommend at the same time to promote investor education and also, the financial literacy towards non-traditional and emerging asset class. So that, we believe in the long run, the investor can get the relevant knowledge to understand the risks and benefits of those emerging products, so that the market possibly could be relaxed at that stage, so that we can say that this is really some sort of a test bed for Hong Kong to really a sort of innovative developments at this point in time. Thank you.
Fantastic. Thank you. Thank you very much, Lisa and Edward, for your thorough presentation of the key ideas that we have highlighted in the report. The report is already online, so go download it if you haven't. Read it as the typhoon hits us. But before that, King, I need to start the panel discussion with you. This research report places great emphasis on market liquidity and product diversity, identifying these factors as crucial drivers of overall economic stability. In particular, it focuses on private market investment and alternative asset class. Well, you were in the asset management industry for decades. And with that experience, I would like to see how important you feel it is to include these non-traditional asset classes in the investment portfolio, and how does this inclusion contribute to the broader financial ecosystem?
Right. Rocky, before I answer your question, I would like to thank Lisa, Edward, and the working group members for this excellent paper. In fact, it's very timely, as we all know. The government just set up a working group to look at market liquidity. So coming back to your question, definitely market liquidity and product diversity are very important drivers, but not just for the financial market, but also for the real economy. I say that because we all have been talking about listed companies, but where do they come from? Right? They all started with small companies, startup enterprises. So definitely they need funding beyond the public market. And that's why the private market is important. Venture capital provides startup funding for innovative companies and technological innovation startups. So these are key drivers for our future economy. And private equity help help these new startup companies to mature and become, hopefully one day, successful listed companies. So, and we talked about, not just private equities and asset class for investment, right? It really helped drive the economy. And when you look at it from an investment portfolio perspective, we should really use these private markets to help develop local financial markets, be it not just startups, but our local fund managers, financial institutions, and even our pension funds, right? May eventually should include some exposure to long-term investments. After all, pension funds are very long-term. And last but not least, we also talked about sophisticated investors, private, the professional investors. The reason why we put forward a paper back in 2020 to promote the development of family office, partly is to attract these private capital to Hong Kong. And that's why I explained the importance of developing an ecosystem with transparent pricing discovery mechanism.
Fantastic, King. And I think it is very important to have a more inclusive market where people can pick and choose what they want. But at the very least, these options are presented to them so that they can pick and choose, right? Very important. Lisa, I'm coming to you with this question with regards to the rise of novel and complex product, which definitely warrants our attention. How do you see the evolution of regulations and policies that support the development of public and private markets in Hong Kong over the recent years?
I think we should be all very proud of our regulators in Hong Kong. Financial regulators in Hong Kong, on the one hand, of course, we recognize, as I said earlier, the importance of investor protection, in particular in the light of the very active participation of our retail investors. But on the other hand, there have been so many examples of our regulators trying to accommodate financial innovations. There have been so many examples, like mining companies, listing requirements, biotech companies, pre-revenue biotech companies, weighted voting right companies. All these are very good examples demonstrating our financial regulators' willingness and ability to respond to financial innovations. One thing which is worth noting is the examples which I have given just now are all to do with, modification of the existing listing rules, in particular, relaxation of financial eligibility requirements or modification of suitability eligibility requirements for listings of companies on the Hong Kong Exchange. These are all, very good messages to the market and very helpful, but we might have come to a point where the market has been evolving so quickly. We see very new novel products in the market where it might be too difficult to respond to innovation or to facilitate innovations merely by amending these listings requirements or other regulations on a piecemeal basis. Question is whether we should also consider something which is slightly different in terms of, who would be giving access to these products, and maybe we should consider a slightly different approach, which is what we have suggested in the paper. Not the usual prescriptive requirements, but more a disclosure-based requirements. But as a result of that, question is, should we start with limiting access to these products to professional investors? Like we were talking to Angelina before the webinar, I think a good example is virtual assets. The starting point was actually just to limit that to professional investors. And now that these products are available to all members of the investing public. So again, these are really good examples of this not being new in Hong Kong. There should be really a lot of precedents.
Absolutely. I can't agree more. Firstly, I think it is necessary for us to acknowledge that the regulators and the stock exchange have been doing a lot in relation to regulations to enable investors and issuers to a more efficient platform, rather, I guess. But the second thing is that regulations at the end of the day can't go faster than technology, and it shouldn't be regulating the technology. And therefore, without knowing what is going to be in front of us, we should have something that is, free for all, like it enables and encourage innovation, to say the least. Edward, I'm coming to you with a question with regards to the market conditions, since you are heavily involved in a lot of such activities. Well, we can see that over the years, there are some slight changes, as Lisa mentioned in her presentation, that a lot of companies try to stay private as long as they could. And well, I would like to see how the current state of fundraising and relevant market activities in Hong Kong is, and then also how is the liquidity condition of Hong Kong's public and private market, as well as that for the primary and secondary markets.
Okay, thank you, Rocky. So as King mentioned, I was at this report timely in the sense that the government has set up a special committee to study how to improve the market liquidity. So definitely it's just using the IPO market example in Hong Kong. The Hong Kong market for the first 8 months actually saw sluggish and weaker performance than same period last year. And so giving some figures, as reference, there are 37 IPOs raised only 20.6 billion Hong Kong dollars for the first 8 months this year, against 44 IPOs having raised 53.2 billion over the same period last year. So there's a drop of more than 61% in terms of the amount raised for this period. And also the number of IPO applications being processed is only 95 as of the end of July, against 143 as of the same period last year. And definitely, we have experienced much lower market activities in Hong Kong over the decade because of different outside factors, like the increment in the Fed Reserve interest rate from a 0.25% to 5.5% in just 15 months. And also there's at the same time, there's continued tapering in debt repurchase of the market. So this period of steep increment in interest rate really actually making funds, the investment cost has significantly increased so that they are more cautious and have a lower risk appetite in order to invest in the market. And on the other hand, the average daily turnover of the Hong Kong exchange has dropped from 166.7 billion at the end of 2021 to 124.9 billion at the end of 2022, and only up to 113.6 billion as of the end of July.
Mm.
So in turn, in short, there's a 32% drop compared with the end of 21. So definitely from the secondary market on the stock exchange for fundraising, this also dropped. I mean, from 442 billion for 2021 to 147 billion for 2022, and that's only 10 billion for 7 months this year. So there's almost 90% drop. And also, I mean, for the private market, this actually is measured by the asset under management by the PE firms. Actually, over the years, there's been significant increment in the market size. And now Hong Kong remains the second largest PE hub in Asia. But because of the volatility I just mentioned in recent months or years, Hong Kong PE market has also the potential for more growth because the investors like to diversify their investment into the private market as well. But the PE market in Hong Kong is actually very small. This only accounts for 3.8% of the market cap of over the public equity market. In contrast, this ratio much higher in mainland China. That is around 13.5%, and also other countries like in US 11% and UK 22%. So that and trading in the private equity secondary market also scale rapidly. It actually has been double over the years, up to 106 billion in 2022. But this trend actually has been also impacted a lot by the market sentiment over the year. So that the transactions for the secondary market for private equity has been somewhat slowed down because there's a lot of funds that fund has been captured in the previous investment because the exit channel has been wide open comparatively in the past.
Oh, thank you. You know, Edward, for sharing a lot of useful data with us. I can see that in general, just like the other external markets, our capital market is facing some challenges because of a slew of external conditions. You know, I like how you pointed out the ratio of our PE market size versus that of our public market. It presents to us a catch-up logic. Well, if we play TV games, right? Is the catch-up logic that when it starts from a low base, there's always a chance for us to catch up. I can also see that there are potentials for us to gain, but we ought to do something with regards to the product innovation and the market landscape such that people can pick and choose what they want to invest in and what channel they would like to use going forward. And with that, Angelina, I must come to you. With your rich experience in both the regulatory space, the exchange space, virtual asset space, advisory space, I don't know, like there are so much that you have done, and therefore, you know, I must ask you about certain things. But I would like to start with this in relation to financial innovations and especially in the space of virtual assets, right? So you can see that a lot of people have been turning away from the traditional asset class or perhaps diversifying their portfolio from the traditional asset class to that of non-traditional asset class. How do these challenges differ from those encountered in the more traditional investment space that you have seen in the past, or your clients have seen in the past?
So thank you, thank you, Rocky, and thank you all on my esteemed panel. It's been an amazing time to do this report. So financial digital assets are basically probably the newest type of asset class that's come out in probably in 100 years, if we think about it. Because when you think about in Amsterdam, you had the tulip crisis, and you had the stock markets in the early 1800s. If you think about it, Bitcoin, when it was first debuted by Satoshi Nakamoto during the middle of the biggest financial crisis globally, then you think, wow, how far have we come in terms of different asset classes and how different the asset classes are, but yet they share common characteristics. So if we go back and think about it, when Satoshi Nakamoto came up with the white paper, basically they wanted to create a peerless or peer-to-peer system that would be free from any other manipulation by governments or by one single body. And they created something that was so unusual that many people didn't understand it in the beginning. But what that did do, the Bitcoin protocol spawned a whole series of new products, new services, and now we have virtual assets regulation because of it, and the opportunity for investors to get involved in a brand new asset class that is very different from traditional asset classes. Now, why is it traditional? Well, first of all, traditional asset classes such as stocks and bonds, they've been around for a long time. We have advisors, we have great lawyers, we have investment bankers that help companies raise funds. But for digital assets, some of them came from companies that needed to raise funds. So they used the public blockchain to either tokenize their assets, or they used tokens to raise funds for their blockchain. Or in the case of Bitcoin, to keep the peerless system going, what you get is Bitcoin. That is the reward to keep the system going. And if you're a college student and you had a computer, you can link into the system, you would get a reward of Bitcoin. And you hear of so many stories of young people who became Bitcoin millionaires because their little Bitcoin started from $1, and at one point it was up to 100,000 US. So this whole financial movement and financial innovation has brought about a number of improvements in terms of moving even into the traditional asset space. And so you're seeing now more and more the original digital assets space moving into traditional finance and actually merging together. And now with the licensing regime that we've put in Hong Kong, which has been, we are one of the first in the world to actually have a comprehensive licensing regime. And I think that we have to thank our regulators for actually taking the time to do this. We have to thank IOSCO for coming up with a blueprint for all regulators. And what this brings is new opportunities, moving into mainstream for digital assets. Regular investors can get involved and not worry about exchanges collapsing. And those are some of the things that we've experienced with the collapse of FTX, with the collapse of different fund managers such as Three Arrows. With regulation, there'll be bars in place in terms of what firms offering digital assets to investors will have to follow. And it's going to be a much safer market. Now, it might be slower, but nevertheless, we still get the benefits of new assets and new products coming out. And what you're seeing now is Hong Kong has the first ETF based on Bitcoin. We were the first in Asia Pacific to offer this. And this actual innovation in itself, and the fact that we can do this now, it's really merging together both ETFs and digital assets together. So opportunities and key challenges. Well, first of all, opportunities, investors will be able to invest in new products. We'll have more innovation and faster churn in terms of getting more people into our markets. That's what we hope is going to happen. The challenges will be, how do we educate people? How do we teach them about security? How do we make sure that they don't throw their public keys or their PC into a landfill, for those of you who remember the case, into a landfill and try to dig the PC out to find $1 billion of Bitcoin in their computer? So education and having the right regulatory regime in place is really going to help traditional fund managers as well as digital asset fund managers work more closely together and be able to offer their products to investors. So you're going to get, as I said again, more adoption from the mainstream. I'm seeing it go into pension funds. Bitcoins are now allowed into pension funds. And you're going to see the challenges actually go away as more people understand how to trade digital assets and how to hold them.
Fantastic. Thank you. Thank you so much, Angelina.
Mhm.
I still remember how we first started the discussion around regulations of the virtual asset service providers back in June 2021. And, we are really grateful for your help and also, nudging us that, this is something of interest to not only the FSDC, but also Hong Kong in general. Yeah.
So
So
thank you to you and King that believed in it and all of FSDC. And that's how we were able to discuss with the government now. Same challenges, same regulation. Now we have regulation in place to protect investors.
Yep. Thank you. Thank you. Now, I'm going to turn to Edward before, and we are going to ask other questions around tokenization and virtual asset. But Edward, in the report, we suggest that a professional investor only market should be established and it can accommodate a diverse range of products. Can you perhaps share the priorities, what kind of innovations we should pursue, and how can this platform be beneficial to the public?
So now Hong Kong already has a license regime for virtual assets, effective June this year, and is also open to retail investors, subject to conditions. So definitely, the priorities would be on the other products, like for bond market and securitization market. Definitely, this may not be really known to retail investors, but they have been really instrumental and also frequently used instruments for experienced investors and also business and institutional investors to diversify portfolios and manage risks. And also, for bonds, the market should also consider to facilitate the secondary market transactions for PE funds. And for bonds, because now we are talking about the green and sustainable bond, and also Hong Kong is actually a swift connector regarding the One Belt One Road initiative. So definitely there's a lot of opportunities, for the bond market in Hong Kong and also securitization products. And so in short, this active market of bonds and securitizations will enhance Hong Kong positions as a global financial center and also as a offshore R&B hub.
Fantastic. I really love how you, with your guidance, we have highlighted in the report that, bond and securitized markets should be something of interest, and also how Belt and Road projects some of these projects are requiring a big lump sum. And we probably need to have a fractional or securitized ownership such that, more people can get involved, right? And that is in part enabled by the tokenization or other forms of technologies that may be relevant. And that's why, I'm coming back to you, Angelina, as I promised. Tokenization is something extremely important, and it has emerged perhaps into the mainstream already in the traditional finance side of things. So as it allows fractional ownership and increased liquidity for traditionally illiquid assets. In your view, do you believe that tokenized assets have the potential to gain traction among professional investors and, in a professional investor only market? And what sort of asset classes do you see as particularly suitable or of interest to these people?
I think, Rocky, that tokenization is going to be the next huge step forward. And we already know from the SFC that they will be issuing a huge consultation paper on tokenization within the next 2 months. And this is going to be a huge game changer for Hong Kong, because we will be, again, one of the first markets to actually put out a tokenization framework guidance for issuers as well as investors in the tokenized assets markets. And this is really a long time coming, because you saw in the 2016s, 2015s, you saw the rise of initial coin offerings that went up and then they just collapsed because there was no responsibility, documentation, due diligence, and rules for what the assets that were being issued with coins. But now we've moved so far forward in terms of through virtual assets and now with tokenization. I think this is the area that's most being looked at by property, loans, art, and as Edward said, this is a huge area for the Greater Bay Area for many of the assets that might need to be fundraised to build the Greater Bay Area. So we're looking at projects that could actually occur in terms of just moving Hong Kong and China closer together as one Greater Bay Area. So the tokenization process, what's going to happen, hopefully with all these new guidelines and rules in place, it'll be very clear. It'll be very clear if there's something wrong with the tokenization of how there could be redress. There'll be protection for investors. And what it will say is basically, how will the tokenization look like and what will you get? And basically, what are some of the assets that will be tokenized? I also caution, though, that if it's a crappy asset, no matter how you put it, either in a listing or a tokenization, it's going to be a crappy asset that's tokenized. So I think in the beginning for our professionals only market, for the good of the market, we should get primo assets in terms of good pieces of land and start it rolling with a professionals only market, get it going, work out the kinks. And that'll be a good time afterwards to allow retail investors into this. So I think the idea of a professionals only market is so important for this, especially for the launch. It works out all the problems and then retail investors can also gain the advantage of getting into this market.
Very important. From illiquid asset or very pricey assets such as museum grade art pieces, that kind of thing will maybe something to look at and can benefit from this tokenization market. And with that, I think Lisa, you will need to contribute to the setup of such regulatory framework because at the end of the day, without proper regulations and policies, it will be quite difficult for this market to thrive. And so in your opinion, what is the most effective way to regulate or perhaps the most effective regulatory framework in this regard?
A very good question, Rocky, but a very difficult question, in particular when you're asking me about the most effective regulatory framework. This is going to be a lot of work for our regulators. I won't be able to say what is the most effective, but I think a possibility is that to recognize the difference in nature of a professional investors versus the wider general investing public. These are investors, as you know, in Hong Kong, under Hong Kong law legislation, there are various definitions of professional investors over the years. This is not new at all. So we have to make use of the perceived high level of sophistication, expertise, experience of our different types of professional investors, making use of that, because we won't be able to prescribe very specific detailed requirements like what we are now having in terms of suitability of an investment product for our investing public. That would be very difficult when these products develop so quickly, as Angelina just described. Over the years, they could be changing so quickly, they are developed so quickly. As a lawyer, I also want to emphasize that regulations are not there to prohibit financial innovation. In fact, regulations are there to promote, to facilitate financial innovation. So it's even more important that we make use of the level of sophistication of our professional investors when we are launching a new product in the market before the products are made accessible to the wider general public. So which is why disclosure-based is, I think, a very important, or principle-based or disclosure-based is a very important part of the regulatory strategy or approach suggested in our paper. Of course, we will welcome ideas, suggestions from the market, from the other practitioners, and also, most importantly, from our regulators. But it's not just regulation. I think during the course of our preparation, our work on the paper, many of us also raise a very good point about the importance of education. Angelina already, quoted a very interesting example, again, in the context of virtual assets. We don't want people merely to blame the regulators or to blame the brokers, intermediaries or professionals, advisors when they suffer a loss in their investment. We want investors to be making informed investment decisions. So it's very important that in particular, in the light of these innovative products, what are these products actually, what do they actually mean for the investor? Education of investing public is one thing, but on the other hand, we also need to make sure that our professionals, our intermediaries are well equipped with all the necessary expertise and experience. So as Edward mentioned earlier, currently there are a lot of green finance products, sustainability-linked products. What do they actually mean? Do we have sufficient number of analysts with the relevant expertise to analyze the benefits and, very important, the risk inherent in these products? So this is going to be a very wide education process. It's not only for the investors. We should also be looking at universities, professional education, what is actually available in Hong Kong and around the world. So a very big topic.
A tall order for the regulators to come up with practical, principle-based or disclosure-based regulations. Education needs to be enhanced. Ecosystem need to be built out. Very important. King, you are one of the key proponents of the setup of this private market or professional investors only market. How do you actually expect the capital market or investment landscape to evolve as a result of the emergence of this professional investor only market? And more importantly, I would like to point to the fact that FSDC has been devoting a lot of resources to the asset and wealth management industry. How do you feel that the emergence of the professional investor only market will disrupt or lead to changes in the asset and wealth management market?
Thanks. First of all, I want to echo what Lisa just said. I think the ecosystem is very important. And in a sense, this paper is also very timely because the regulators in Hong Kong just introduced this sophisticated professional investors regime.
Yep.
We're glad that our recommendation jointly put forward together with PWMA got adopted and implemented. So the implication, I think, is quite broad because the concept of having professional investors is not just to facilitate the onboarding, the AML, product suitability process, but more importantly, allowing product innovation, right? And this is not unique to Hong Kong because if you look at other markets, take the US as example, they have actually more than 50 alternative trading systems called ATS. The presentation mentioned the Nasdaq private market. They also have, OTC market, which is known as the pink sheet market in the past. Even Macau now has MCEX, right? So definitely that's a trend. The Bank of International Settlement actually published a paper, a report on the rise of private markets in December 2021, highlighting that private markets have become a very major force in all aspects of firm financing and restructuring, not just in advanced economies, but also in emerging economies. So with the ecosystem in Hong Kong, I think Hong Kong has an opportunity to become a regional private market hub. Just to highlight the need to have a trading platform, because I think that's the next innovation we need to have. Is to come up with a platform to facilitate pricing discovery and liquidity enhancement for private alternative market products. The Global Association of Risk Professionals, GAP, also published an article earlier in the year with the title that the growth in private markets attracts trading platforms to serve them. So that highlights this the need for private trading platform is global, is universal.
Mm-mm.
Thanks. Thanks.
Thank you. Thank you very much, King. In fact, I may want to stay with you, noting that we only have 10 minutes left, and you highlight a very important point about regional private market. That concept is extremely important because, after all, Hong Kong is not a market just for the 7.4 million people living in our city, but rather for us to, connect with the rest of the world. And this is important because HKEX has recently announced cooperation agreements with the Beijing Stock Exchange, the Indonesian Stock Exchange, Saudi Group, and what Saudi Tadawul Group. And what, in your view, are the key opportunities and potential impacts of such partnerships and connectivity, particularly in terms of enhancing market depth and breadth?
Right. Yeah. It's a very complex question. So I'll try to give you a very brief answer. I think now it's a multipolar market world. So more collaboration regionally is definitely the trend. We talk about collaboration between Hong Kong and Beijing. We could expand that concept through these MOUs, right, among markets to develop a regional SME market, a bell and roll market, right, for listed securities, for unlisted securities, through the private market, and even the bond market. We can, going back to what Edward said, right, refinancing some of the the bell and roll infrastructure projects. Some of these projects are quite matured and can be turned into asset-backed securities and traded in Hong Kong in renminbi and other local currencies. Going back to what I just said earlier, now we're in a multipolar environment. So, we can have multiple currencies for regional products traded in Hong Kong.
I think this is very important. And that goes back to what you mentioned in your answer to the last question. It really facilitates the price discovery process, or make it more efficient in other words. Edward, considering that stamp duty has proven to be an effective means of generating government revenue, how does the industry view the current stamp duty imposed on equity trading in Hong Kong?
There's a lot of discussion lately, especially when the China Authority has halved, the stamp duty of stock transactions, just announced this Sunday. So definitely, we acknowledge that the stamp duty is constitutes major fiscal revenue for government. But when we look at the mature economies in the world, actually, only actually Hong Kong has charged the highest stamp duty, in the sense that each payable by a buyer and a seller, and also the major leading international finance center, other than Hong Kong and UK, do not impose stamp duty on stock transactions. So definitely it's time to really to have a look to see how the stamp duty can enhance the competitiveness of Hong Kong capital markets, and also ensure Hong Kong is in a level playing field with other international norms. Although I can say that this is not a panacea, for the small market liquidity, but definitely, to maintain Hong Kong competitiveness is a very important factor. Especially, in the past, the government has also have stamp duty exemption for some new products like ETF, like the debt securities, that actually had also, need to, increase liquidity in the market, and also the overall trading volume market has increased for that kind of products. So, and last but not least, there's also one important factor, because nowadays there are more and more companies that is, globally connected in terms they have different listing in different places. Like, there are Chinese concept stock that list in both US and Hong Kong, but US you don't have any stamp duty, but Hong Kong, you have the stamp duty both for the buyer and seller. So definitely, there are some considerations that Hong Kong should revisit to ensure that it remains competitive under the international norms.
Thank you. Thank you very much, Edward. I'm sure Angelina has something to add in her capacity with IMC Trading.
Yes, I work with a very large market maker, and the stamp duty, of course, is a very, very big issue for a lot of flow traders because for every turn that you trade, the cost of stamp duty brings up the whole cost of the transaction. Now, if we were able to lower the price of the stamp duty or get rid of it, you'd bring in a lot more market liquidity into the market because people would be trading equally as other markets. And I think you're going to get a lot more people coming into Hong Kong, as well as a lot more trading if we were able to bring down the stamp duty and the fees around that. So I think this is something I know that we need to, I know the government is very concerned, of course, with tax and to be able to bolster its financial position. But I think there has to be a give and take in terms of how much stamp duty is actually charged, and is there a way that we can actually figure out other means of also helping the government, but also bringing in liquidity. And I think just evaluating stamp duty and bringing it down at least 5 to 10% will actually already start helping the whole process. If you get rid of it, it will equalize us with other markets. I think that's something that's very important.
Thanks a lot, Angelina. We have received quite a few questions from the floor, but I can't, address them all, given the tight time frame. But there's this one that is very interesting, and I think both Lisa and Angelina may be, able to address it very intelligently. That's assuming this new proposed PI market is disclosure-based instead of principle-based. How do you see the role of sponsors in such market? Is it going to reduce due diligence or even not sponsor-led anymore? Perhaps, Edward can also chime in later on as well. So whom shall I start with? Lisa?
Yeah, good question.
Very good.
Do sponsors actually no longer have a role? I doubt very much. The fact that this is, I would emphasize, this is not going to be rule-based, meaning that there will be, unlike, the current listing regime where you will have a lot of checklists as to specific requirements, as to financial performance, eligibility, qualification requirements, etc. But that doesn't mean that there would be no regulation, no requirement at all. There is still, again, depending on the type of the products in question, which we don't know yet, because it really depends on, I would imagine that, say, a green financial products would be very different from a virtual asset. That's an example. So there will still be requirements as to what the key features are, and very importantly, the risk disclosure. So the fact that these rules are not, or these regulations are not going to be rule-based or specific requirement-based, these are more principle-based or disclosure-based, would still mean that someone will need to do their homework in identifying the key risks involved in the investment and make appropriate disclosures in a full and frank way to ensure that we continue to protect the interests of our investing public, and very importantly, to maintain the very high standard and integrity of our Hong Kong financial markets. So I think the role of sponsors might be slightly different, but the nature wouldn't change. That's my view.
Can I just add that Lisa's absolutely correct. The sponsor will be there, but also regulators, including the International Organization of Securities Commissions. They basically feel that, look, you need to know who's behind the product. And if you're selling the product, if you're the virtual asset trading platform, you better be satisfied, know what you're selling before you unleash it on investors, be it professionals or otherwise. So although a virtual asset trading platform isn't a sponsor, they have a responsibility as a licensed platform to do the right thing and make sure that the due diligence is there. And all of those requirements are already laid out in the new regime that's actually been issued. So I think that responsibility, no matter what, is going to pervade all the way from sponsors to companies that are actually listing these types of assets.
Totally with you. Edward?
Yeah, I mean, even in the US market that have disclosure base, I mean, for a long period, there's still a role for sponsor. So definitely, I mean, the due diligence process, I mean, for sponsor actually has some value to hold, I mean, the listing process. I can say that, I mean, although to some extent, there'll be some reduction of work, but I'm sure that sponsor had a role in terms of due diligence in other, I mean, advice, I mean, to the company in the listing or other process.
Sounds great. We are coming close to the end of the hour, And I would like you to stay with us for a little bit, as my colleagues will be pulling out the polling questions for you, just that we can see how we can improve for the next industry exchange series. And with that, thank you very much for joining us today. And I look forward to having you guys again in the next IES that we are going to hold.